Once we get past that piece, we then start looking at other options outside of the public markets. This is where we come back to that private deal. Those can be very advantageous, but may not make sense for everybody, and often come with a higher level of risk and illiquidity. So, in order to keep ourselves out of a jam, it makes sense to make this the next level that we'll look at. We often will look at this level as either a diversification of asset situation, or sometimes even straight up what we refer to as FU money.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required, where we challenge you to think about finance differently. I am your host today, Dan, and today we're breaking down the order in which you should invest your money. We often hear from clients, my friends are investing in a private deal. Should I do the same? Well, it's a great question, and as you would expect, there's several layers to the answer to this question. First things first, if we were to visualize such an answer, I would ask that you look at this sort of like a pyramid of champagne glasses is often the analogy that we use here. Champagne glasses, let me start again. First things first. First things first. I would ask you to think of this answer in the form, if you can envision, of a pyramid of champagne glass, where you've got one glass on top and then layers building out that pyramid. First layer is pretty much the same for everybody that we encounter, and that is, do you have enough cash on hand for your emergency fund? Scarcity is a real thing, and when there's not enough cash, we see everything from panic selling from an investment standpoint to not making optimal decisions in general based out of just common day, everyday fear. So the first thing that we want to do is fill up that first glass. Now, when you fill up that first glass, the question is, how much cash do I really need for an emergency fund? Rule of thumb for us is generally to look at this as 3 to 6 months of total expenses. I'm not a huge fan of rule of thumbs, but it's a good place to have a starting point. Most of the time, the biggest threat that we see to an emergency fund is a loss of employment. Hence why we want that to be there, so that you have a secure mindset going into your next job, a runway, if you will, where you don't have to worry about upcoming expenses for X period of time, and therefore can interview your best self. That's glass number one. After that, it gets complicated. Before I jump into that, let me point out an issue and the reason why there needs to be a system as to how this breaks down that we see. The issue is this: regardless of people's wealth, in fact, I would argue to say the more wealth, the more this issue actually comes up, is people will pour at different levels of this pyramid, but never really filling up one glass. You pour a little bit here, you pour a little bit here, and a little bit here. And we think of that as diversification. But what it often is doing is actually creating a fragile environment because we're no longer balanced. Not one cup filled up, feeling fulfilled, and therefore our weight is off and other things impact other things, and we look at a situation that is just not as stable as perhaps we think we're creating. So, first glass, boom, emergency fund. The idea then is that flows over into the next piece. Now, the next piece and one we look at is cash that we need or cash equivalents for more immediate terms of expenditures, usually anywhere from perhaps weeks to a year to sometimes up to 3 to 5 years, depending on the inflationary and overall market conditions we're looking at. This cash is stuff to take care of projects that we know are going to come up, planning for a wedding, planning for a house down payment. We don't want that money, if we know that we're going to be buying in the next couple of years, tied up into something that is illiquid or difficult to get out of, or presents issues of loss to take money out of. Therefore, we want those cash funds stable, but separate from our emergency fund. If indeed we feel secure there, we then move to, are we maximizing and optimizing how we're actually utilizing our money? Now, in this run, if you will, we're looking at 401ks, 403bs, potentially pension plans, Roth IRAs, and IRAs. Assets that are considered qualified assets, meaning the IRS has given benefits from a tax standpoint to invest in these vehicles, but they come with liquidity challenges. However, the reason why we recommend this is we have to not just think about today, but we obviously have to think about tomorrow and the next day after that. From a tax standpoint, this is typically the best opportunity we find for individuals to invest in. Another reason why we want to look at qualified accounts is that within a 401k or other employer plans, we typically are seeing a match. And therefore, nobody wants to give up free money. We want you to take advantage of that. If we get to the point where that is being maximized, then we move towards other non-qualified assets like brokerage accounts or stock options, especially if those stock options present benefits through an employer plan. So we look at those other assets. Now that can be used for pre-retirement. It could be used for a dream project, perhaps another property, perhaps the dream property, whatever be the case. A mistake that we have when people fill up this level of the pyramid is that they don't put purpose to those non-qualified funds. Everything else we've talked so far has purpose. Emergency fund has purpose. Short-term cash needs have purpose outside of that fund. And obviously retirement has a designated purpose. This next level, we want to find purpose to really maximize utility. Once we get past that piece, we then start looking at other options outside of the public markets. This is where we come back to that private deal. Those can be very advantageous, but may not make sense for everybody and often come with a higher level of risk and illiquidity. So in order to keep ourselves out of a jam, it makes sense to make this the next level that we'll look at. We often will look at this level as either a diversification of asset situation, or sometimes even straight up what we refer to as FU money. In other words, these kinds of investments you absolutely can take a total loss for. We want to make sure it doesn't affect your overall financial planning. And quite frankly, you may not like it, but you can walk away just fine having taken a zero. So that's really when we start talking about private deals, private equity, and the order in which we would suggest you follow the pyramid, our decision tray, if you will, on whether or not you should jump into that question of, hey, is this private deal something that I should look at? Maybe, but let's not put the cart before the horse. Thank you again for tuning in to Critical Thinking Required. Until next time, have a great day.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,